What's up, everyone? Welcome back to Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And this is the first show of the brand new year. Happy New Year, Brian.
Happy New Year, Andy.
Will, sorry we're missing you this week. You guys, Will starting the year sick. That's no good, but we're going to have him back next week. So today you get me and Brian. And Brian, we have two big mortgage topics that both are underpinned by the huge news you've already heard, which is Fannie and Freddie to buy $200 billion with a capital B, billion with a B, of mortgage-backed securities to help, I'm going to say, artificially lower mortgage rates. Let's just be honest, out the gate here. Brand new year, brand new. Nope, I have said that before.
Same me.
So today we have two topics. So the first one, Brian, we're going to go through is the quiet shift from rate shock to affordability engineering. The second thing is the growing divide between equity owners and payment buyers. Both now are going to be underpinned by this whole brand new topic or brand new news headline of mortgage rates coming down. So let's start from the top, I guess.
Yeah.
By the way, welcome back.
Thank you.
You've been out for weeks, you guys. Brian broke his ankle in 2025, and now he's finally back in 2026. Look at this, air cast and everything. Oh my gosh. Takeaway.
That's actually pretty good. I haven't stretched that.
When you get older, stop trying to wrestle your cousins.
Yeah, who would do that?
Yeah, who would do that and end up in an air cast to end the year?
Oh.
So let's talk about the quiet shift from rate shock to affordability engineering. Up until literally this week, it's been all about affordability. Rates are high, or they're historically high, but they're not historically high. They're historically high in the small time frame of the last 5 years.
Yeah.
They're not historically high in the time frame of 10, 20, 30, 40 years. But affordability has been the issue with elevated house prices and elevated rates. Now, what do we tell people, given the fact that rates are now soon to come down?
Well, I believe it's the big break that a lot of people have been waiting for, and I feel that everybody's been pinned up and waiting for it to happen. And we didn't know how it's going to happen. We just know that there was pressure, and everybody wanted rates to come down, and we're like, hey, we're waiting for this. Fed come up. They didn't give us the answer that we wanted, or didn't give us the results that we were really looking for. So this week, completely, there was a wrench thrown into the machine, and boy, did we see that in pricing, and did we see that throughout the markets. I mean, just with the two statements that the president dropped, the one about, institutions not being able to purchase single family residential properties because they say families live in homes, not corporations. But then the biggest one was, what he followed up with when he said Fannie Mae and Freddie Mac are not to buy $200 billion in mortgage-backed securities. And for those that for those that forgot, back in 2020, the government was stepping in and doing this along with buying, mortgage bonds and mortgage-backed securities to bring rates down. So what that means is that in these next couple of weeks, we're going to see a huge price drop in rates. And we may not see like a crazy dip in rates like from 1% to 2%, but the cost for your rates are going to start slimming down. And we're already, below that 6% threshold. So just keep an eye out that rates are going to start continuing to follow that trend, and we're going to make our way down and start descending.
And for those of you following along with tricky language at home,
yes,
this is what the Fed traditionally calls quantitative easing.
Mm-hmm.
Quantitative easing is when more money is put into the system, thus reducing the interest rate and making it more affordable for everybody. I do air quotes because my jab, left hook is, guess what? Home prices are going to stay.
Yeah.
Now home prices are for sure going to stay.
Yeah, 100%.
The predictive 5, 10, 15% drop off. Again, some places it might still happen.
Well, it already did happen.
But
some
yes. Well, I was just going to say that. Yeah, you're right.
Sorry.
No, you're right. Some places it already happened.
Yeah.
Some people are still projecting that it could happen, but this reduced rate is going to increase cost, and it's going to solidify that some places can probably stay.
Yeah, and not to alarm anybody, but I am going to say that, if you're hearing this right now, you need to start making that move right now, because by the time you hear it in a week or two from the mainstream media, the market is already going to dilute all that, and we're going to be in a different trading channel. So right now is when you need to be striking. You need to be talking to your loan officer or your preferred real estate professional, because the time to strike is right now.
There's something I wanted to bring up, and I want to get your opinion about this, because I kind of had this thought, and I want to share it for everyone to involve themselves as well and engage and tell us if this is a good idea or a bad idea. But up until this week, we have been telling people for years now, negotiate some sort of closing cost credit towards a rate buy down. Mm-hmm. Would you still advise someone to do that, even in a lower interest rate environment, and why?
the way that I engineer deals is always based off the goal of their monthly payment. So, given that, we're in a higher rate, environment for the last couple of years, those payment goals fluctuated and, were a little bit different from what people would want them to be. So my question is always like, what's your monthly payment that you're looking for and how can we get the closest to that or get right on that? If we don't need to bring the rate down anymore and they're okay with what the payment is, then great. That means we could still ask for credits to pay off just your regular closing costs. And I would always advise if we have enough to bring down the rate a little bit more, hey, a lower payment doesn't hurt at all, So what I say is that if you don't need it, that's okay. We're still going to ask for credits because if they can give them to you and you can pay for your closing costs, great. But I don't think that there's going to be that pressure on having to bring down the rate as much more than just covering your regular closing costs.
So I'll play devil's advocate real quick is, maybe you're in a deal where there is a second bidder.
Yeah.
Maybe you are saying, hey, I need $20,000 for a rate buy down and the other bidder doesn't. Now, what do you do in that case?
So in that case, we really have to speak to the borrower and let them know, like, hey, there is another offer out there that isn't asking for any of these concessions, that isn't asking for any of these requests. And there's conversations that I've recently had where we actually had two borrowers on the same deal. Two offers, and one of them was coming in over asking price, no closing cost credits requested. We're in escrow. We got our closing cost credits, but because of the price being too high on the other offer, that they didn't feel the appraisal would come in.
So you're saying it kind of backfired?
So even at a higher price that the other offer was offering, no credits, they still went with our offer because they didn't feel that the price that they were buying it at was going to appraise.
Whoa,
no way. They still went with our offer, $465 over a $475.
Wow.
$20,000 back in credit as long as the appraisal came in. Appraisal came in at $770.
Wow.
So they still chose us over that deal. So what I mean by that is that it doesn't always come down to the price. It really comes down to the negotiation between what the seller's looking for and what the buyer can do. And there was another offer where, there was a buyer that was, didn't have full funds. Their funds were going to come in, as their pay period came in. And I talked to the loan officer. I'm like, okay, I completely understand that. There was another offer, $80,000 in the bank, coming in with 10% down, very low minimum, debt to income ratio. The other one was paying off debt. So right off the bat, I was like, go with the other offer. So it really comes down to how enticing your offer is, and over asking or sending the highest price isn't always what's going to beat you. It's what you can give to the seller that they're looking for, and you can make them feel confident that that's what they're going to get so that they can move to their next step.
Yeah, this is completely like engineering the affordability into the deal.
Oh, yeah.
And engineering because I guess I'd say like don't shoot yourself in the foot.
Yeah.
Because maybe I even posed the question like, well, what do you do in that situation? Because it's a real thing. If appraisal might be the value or the deal killer, then I can totally turn in the favor of the borrower who's still asking for the thing because of another part and another variable of the deal. What I think I'm most intrigued by coming into like this, gosh, I really feel like January has a whole new outlook just in the last 48 hours because of this, the news that's come out. I think what I'm anticipating happen for people is them be a lot more aggressive on one side while being selective on the other. Mm-hmm. Like I'm going to be really aggressive about trying to outbid people if I really like this place, but I'm also going to make sure that I'm selective and it's going to be the right one. When there was less inventory, it was less of that. But I think with more inventory on board, rates going down a little bit, I still think it makes sense to consider a buy down, even if you don't need it. Let me say that very clearly. You can still try to work a buy down into your deal even if you don't need it. Because if you can afford the rate at what it's at and the buy down helps you get even better cash flow every month on your monthly budget, you can be doing something with that money, that gap that you were going to spend, and put that in a positive territory somewhere in your financial life or towards your house or whatever you need to do. Just think of that as a tactic and a strategy.
No, it's a great point because, like I said, a lower payment doesn't hurt anybody. And I feel that if you're able to negotiate it, I always tell all my agents and all my clients, ask for the most because the sellers will then come down to what they're willing to give you. And then if we ask for the most, we're going to get something regardless. So be aggressive in what you ask for as long as it's reasonable. But at the same time, one of the biggest factors that I've seen right now that really is what's making the deals happen is the communication in between the realtor and then the lender, and actually talking and saying, hey, what is it that they're looking for? What is it that they want? This is what I'm coming in with. Is that something that will, get us into the realm of playing ball with the seller? And and they'll tell you what they're looking for. Maybe not directly, but they'll give you an idea of what it is that will make the offer get accepted, and do that. Right now, it's not just, shooting an offer at highest price and then hopefully it lands like before. No. It's about communicating clearly what you want, what they want, meeting in the middle, or figuring out a way that everybody walks, with a win.
Another word of caution is don't be greedy. If you were looking at a 6.5 rate in December and now in January you're going to be staring down like a 5.5, don't be like, oh, what about 5 3/8? What 5.25? Yes, I 100% understand that. We are consumers as well. We buy cars as well. We buy property as well. I get that part. However, don't cut your nose off to spite your face. Like if you're just trying to finagle that last eighth or that last quarter and it completely removes the deal from you, then that may not be a good deal. If you're already going from 6.5 to 5.5, that sounds like a good deal. I would say be cautious to yourself and to not be greedy, but also don't look in the rearview mirror and have regrets either. As if you were out of the housing market for the last 2 years, 3 years, and you're getting in now, please avoid looking in the rearview mirror and having regret at, 5.5 versus 5.25. Before the haters go, well, that's of course the sales guy saying that, so you can get a higher rate. That doesn't actually change anything for us, just so you know. So word of caution.
Hey, don't mess around.
Uncle Andy's coming out of the gate hot in 2026.
So, speaking about, you mentioned, being out of the game these last couple of years from the housing market. So in 2020, I met one of the clients that we just approved yesterday. And since then, he's been working on his income. He's been working on his credit. He's been working on cleaning up his credit and minimizing his debts. But throughout the years, we've stayed in contact, and he always checks in and says, hey, this is where I'm at. What should I do next? Hey, this is where I'm at. What do you think I should do next? And we've been following that trajectory for now 6 years. And yesterday, I was able to fully approve him, send him his conditional approval. And after 6 years, he's now going to be able to go and start shopping for a house. So it doesn't matter how long it takes, but, I got a little emotional with him because I'm like, bro, I remember you reached out to me on a DM saying, hey, I want to buy. You weren't ready. We tried to do it. Credit wasn't there. That following year, you thought you were ready. It wasn't happening. But then this year, literally during a Christmas and holiday season, he messages me. He's a Cowboys fan. And I'm like, hey, bro, I'll help you either way. It's okay. And I left Philadelphia.
Come on.
So shouts out my boy, Dior Cromartie, because, he stuck around. And the thing that I wanted to drive home is that, if you pay attention and you follow the instructions that, they're giving you, whenever anybody's actually trying to help you to just set up a roadmap for you to buy a house, follow the rules, follow the game plan, because they're not just doing that to just send you away and hopefully you figure out it's exactly what you need to do to get to the promised land. And he followed it perfectly. He did exactly what was needed, and now he's able to get approved and go buy his first property.
I will be the first one to tell you and / remind you that we have said this time after time after time. We do not have a crystal ball. We do not know when things like this are going to happen. We don't have a 3-month, 6-month, 9-month, 12-month forewarning about some of these things. However, for those of you who have heard us say that in the last 12, 18, 24, 36 months, these are the moments we've been talking about.
Yeah.
Is when you are ready, when you are prepared, when you've fixed your credit, when you've saved up, when you've cleaned up your financial life, you got your taxes all sorted out, you got your P&L ready if you're doing a bank statement loan and your non-QM or whatever. This is what I'm talking about, is the fortune's going to favor the prepared, and we're entering this window now where it's going to tip into the favor of the buyers and those who were not able to buy in the last couple of months and years.
Yes.
This is going to be an opening and the clearing ahead, and this is why we say those things. So it's not just because we're trying to say it and fill another slot gap in the show schedule. This is the kind of thing that happens. You just don't always know when it's going to be.
And to follow up to that, maybe switching gears a little bit, now that rates are descending, that's going to unlock a tier of buyers or homeowners that wanted to sell but couldn't sell because they weren't at that price point yet. So what does that transfer into? More inventory and more options for buyers that are actively looking. Just yesterday, we had an offer accepted on a property, $875. Today, the buyer comes back and says, hey, I found another property, same price. 1 more bedroom, 1 more bath. Same price. A little bit bigger, a little bit better, looks way better from inside. I'm like, well, shoot, it's a really good deal. She's like, I want to submit on that. So be wary that a lot more inventory is going to start popping up these next couple of weeks as rates begin descending. So that's why I drive it home, and I'll keep driving it home this podcast. Get your pre-approval, get your numbers in line, get your refinance, a checkup in line, because things are going to move quickly. And this is a wave. We might have another wave that things go back up, but this is a wave to take advantage of the times right now, because like Andy said, we don't have a crystal ball. We don't know what's going to happen, but if you can act on it right now, then, we can assure you that something's going to happen.
So the other thing that's kind of happening is this divide between like the equity owners who had these mortgage rates that are like 2.5, 2.25, 3, 3.5, 4 even, and these, like you were talking about earlier, you're trying to do pricing analogy, and you're looking at affordability with buyers who are trying to buy. Like there's this, the mentality and the psychology between those things, the two things are so different. Yeah. So what I want to do next is I want to talk about for the people who are the golden handcuffs.
Yes.
I don't feel stuck in my home. I love that I'm in my house and I have a 2.5% rate. What reasons would they need to look at adjusting their finances in this new environment with rates coming down? Now, I know that the gap's not going to be completely closed back to 2.5 again, but what kind of things should people be looking for where they might need to have some alleviation at another part of pain point in their life or something, and they might have to look at refinancing because they have a lot of equity and they can. Mm-hmm. I also think there's an investment opportunity with that too, for the garage conversion, ADU build, et cetera, et cetera. Talk to me about a couple of the things you're thinking about, or maybe you're going to start talking to people about now, given the fact that rates are going to be coming into a more favorable position.
Yeah. So last year, there was a few borrowers and clients that reached out that wanted to cash out refinance, but unfortunately the numbers for them didn't make sense, although they were going to be, able to take money out, but it still wasn't within, what they were looking for. So a lot of those people, I feel that are still holding on to that debt. And, across the board, we all know that credit card and, loan debt is up higher than we'd ever had it. So alleviation and being able to do a cash out refinance if you need it is going to be a lot easier, because the rate's going to be lower. So your monthly payment is going to be a lot lower. So that means that all those debts or all those credit cards that you want to consolidate are going to be at a lower interest rate, rather than paying a 20% there, 13 here, 20 there for whatever credit card or whatever debt you have. You're now going to be able to put it all under a lower debt. And for some people, for some reason, when they see 6, it's kind of like a scary number, like, oh, like 6. 5 was a little bit better, but I think 4 is what people are kind of like, looking forward to right now. But I feel that, on the flip side, if you're looking to invest, a lot of people are pent up wanting to do ADUs. And one of the most difficult things I've seen for residential homeowners is being able to get the funds, because it's a primary property. Banks don't really want to give you money to be able to do that unless you're doing just one ADU. And a lot of homeowners want to take advantage of all the laws that California offers for ADU. So I say that if you have the opportunity and you've been wanting to do it and the numbers make sense, you should definitely go and try to see what, getting a, loan against your equity to do some improvements around your house.
I will say this anecdotally to everyone who's watching this. I don't know what time of life you're watching this or what part of the year, but it's January 2026, and the ADU fever is not over.
No.
Literally, to start the week off, one of our friends, the Builder Brian, he had a massive ADU event with Thatch and Wynn, Andrew Greer. I'm forgetting somebody else that was in that group, and they had 3 dozen people, 4 dozen people there who are looking at these are individuals that are looking, I need to do some sort of ADU or some sort of like custom development thing, whatever, for multi-unit. And that's just one group of people we know in this space. I'm not even mentioning all the other contractors we know that's what they do as a trade. And the ADU fever is not over. So if you are feeling like you might have missed out, the rate environment is flashing a sign to you that you did not miss out. And the activity that I'm seeing around the area and the amount of building I see still starting in San Diego also means that you are not missing out.
I think it's a perfect runway for all the people that 2 years ago wanted to do this, but rates were like in the 7, kind of pushing 8s. And they had the equity, but they're like, there's just no way that I'm going to go and take this amount of money and then make my payment like double, triple what I currently have. Right now, that's, not exactly, but, quote unquote, you're like 3% lower, looking to be 3% lower. And that's going to open up a lot of room for the people that saved up all their equity. You're going to be able to go in and tap into it at a lower price range. And maybe now numbers are going to make sense. But I encourage you again to run the numbers, see what it actually looks like, because I have a lot of homeowners that call me. And once we actually run the numbers and look at what it's going to be like, they're like, oh, well, it's not that bad once we kind of have everything put together and I see what it really comes out to be. And you'll see the numbers for itself and you could then make the decision. But I feel that this year, if you had the idea in the years before, it's the time to do it now.
I am broadly becoming more confident in this position that who's going to win. If you look in 10 years from now and you replay history, the people who are going to be winning at that point are the ones who acted in this time frame. Again, that sounds like super like salesy. Oh, he's supposed to say that. I've been saying this kind of thing for years.
But
there's a reason. As more and more of our city landscape turns to have additional dwelling units on properties, that's raising values in the surrounding neighborhoods, and then more people are following suit. It's like a spiral upward. So as prices spiral up, because people are building up their properties and adding a garage conversion, a second story, or an ADU, or whatever version that you want to have your own taste or flavor, long term, a greater percentage of our real estate will look like that in San Diego. And 10 years from now, that's really going to matter when it comes to equity and price and total value of your home.
So 2 big developments are already happening and underway here in San Diego. We already had the one by the Gaylord that still hasn't been fully completed. We have a Seaport Village that hasn't even started, and there's been crazy rumors about that. So just to give you an idea, that's all going to help increase and bring a lot more business, a lot more buzz, and a lot more people wanting to move to San Diego. And what's that all going to do? Raise the price of everything.
I'm going to tell you something. A couple weeks ago, I had Danny Quesada in here, and he runs San Diego CA Living on Instagram. By the way,
that's actually who I kind of followed to learn about that.
When he was here to interview his show on Friends of Mortgage Heroes, he had like 22,000 followers. He surpassed 30,000 just over the Christmas break in a matter of just a couple of weeks. But on the show, I asked him what is an underrated or overlooked city, and he said Imperial Beach.
Yeah.
He said Imperial Beach is like the kind of last bastion of like coastline that really hasn't had the heavy-handed redevelopment that some of the other parts of San Diego has. Yes. And then guess what I started seeing over the last week or two?
Development and
developers and investors. Oh, I just closed a house in IB. Oh, I'm building a place in IB. Oh, I'm doing a second story in this home in IB. I'm like, oh man, he totally called it.
You go down IB, and then my in-laws live in Nestor, so right before you get down to IB, and you start going down, there's houses with lots of land, there's houses with lots of like square footage that you could do a lot of, and there's beautiful houses that are right by the shoreline as well. So it really just needs a facelift, a makeover facelift, and it's the houses are like literally like a PB. It's like literally like a Pacific Beach.
I will also tell you that, driving on the 5 North last weekend, I looked over to the side and I saw half a dozen building projects on the west side of Chula Vista, on the westernmost part of Chula Vista, right by the 5 freeway. Just for like a couple of exits, I'm like, oh, wow, 1, 2, 2. There's like I counted about 6, I think, that I saw just looking out my window while I'm, cruising down the freeway. So people are doing this right here. Yep.
And it's all over Chula Vista, too. The west side of Chula Vista. I mean, I live down on the west side of Chula Vista. There's a remodel going there. There's an addition happening here. There's one right down the street. We just are getting ready to finish the one up in our house. So it's happening. You probably see it in your backyard. You probably see it in your neighborhoods. And if you're a homeowner, you're able to do this as well. It's just about having the resources and getting the information, which is virtually available to everybody nowadays.
Yeah. So buyers, for those of you out there that are not yet in a property yet, I would love for you to take a honest, hard look at your own financial situation to determine what is it that needs to happen so you can grab keys, so you can have a front door to open. You got a place to rest your head now, but also in the changing landscape of the rate land and what that's going to look like, you might even have more options than you did before.
Yep.
Real quick reminder, not too long ago on this show, we were talking about how people have to get creative to even get in, or sometimes they have to sacrifice things they want to just get a place. I got to live further away so my commute's longer. Or maybe I can't get a 4-bedroom house, I got to get a 3. Or I can't get a 3, I got to get a 2. Yep. Or they have to like give something up.
You compensate.
If inventory is coming back and you have more selection and affordability is coming back in your favor, that's a sweet spot to find that match in the market that maybe it worked out for you that you didn't do this in quarter 4 or quarter 3 of last year. Maybe quarter 1 or quarter 2 is going to be the time. Take a serious look at that. Be honest about your situation, and then be aggressive when it comes to your own personal pacing and your own hunger. I don't mean be aggressive at sellers and be aggressive at your agent. I'm saying be aggressive about what your hunger needs to be to actually achieve homeownership.
Yeah, I know, and I second that 100% because a lot of people shoot themselves or take themselves out of the fight before they even have any opportunity to know what it really feels like or looks like. So I would say don't take a no for an answer until you actually went through the steps, you looked at everything, and they said, hey, you're not approved. But then even then, if they give you a roadmap of what you need to do and you don't do it, then it's your fault. But if you take it and you run with it, and then 2 years or maybe a year, 6 months down the line, it works out for you, then you didn't waste time. Then it wasn't a loss. It was just a setback to set you up for what's next.
Final thought from me, actually, it's not kind of final thought, it's kind of like a line in the sand to measure Uncle Andy in the corner, yelling into the microphone, is the price decline has now stopped.
Yeah.
Price declines in your majority cities is now going to be stopped. And, the rates are going to now kind of force the hand on that. If we look down the road long enough and I'm wrong, that's fine. You guys can beat me up in the comments about this comment. Right now, though, I'm kind of calling a shot that right now, Q1 2026, I think you're going to see almost complete screeching halt to price declines, minus the people that dishonestly price their house way out of the strike zone anyways. Those people, I can't even stand in defense of you.
Oh, the tide's coming.
If you had priced and listed your home honestly, sorry, that kind of got all wonky there. My point is, like, if the price of the house that you're looking at was priced honestly, I don't think you're going to see steep declines in prices anymore.
No.
It's only you're going to see steep declines for people who are
you're going to
get way out of their mind.
You're going to get exposed, which is good because then you're going to start seeing what it should have really been. And the market itself would tell us what it needs to be.
The market makes the score, bro. The market makes the score.
Yeah, I just follow. So when they get mad at me, why isn't their house?
Yeah.
I'm right with you, man.
All right. Final thought. What do you want to tell everyone today before we close up?
For me, this year, I think is a year that you have to go for it. If you've been, thinking about it, last year you maybe took a few steps, or the year before that, I think it's this year that you need to actually take action, make a plan, and stick with it, and try it out, and not just do the plan and put it away. Take the action, go run your numbers, see what that looks like, and really create a plan over your life situations to really know if it's a time for you to move or not. And I think that's going to give you the biggest clarity this year. Just be honest.
Last question, Brian. How busy has your phone been in the last 48 hours because of the announcements?
So I haven't been able to get off the phone either. It's because I get a call from a client, I get another, the rates come down. So it's happening. It's only going to happen even more. So start getting ready, get your documents in line because we're here and it's happening. So take advantage while it happens. And we don't know how long it's going to last for. That's the thing, tomorrow, the following week, something could come up in the economy and the world and we take a different course. So what you can do now, take advantage of it.
Awesome. Brian, thank you so much for helping kick off the inaugural show of 2026. I'm really excited to have you back here when you got your cast off and you got your ankle fully healed. I don't think it's going to I don't think it's like quelling or squelching your energy at all, but I'm excited to have you
on the
walking around here.
Pent up.
Yeah. I'm excited to have you walking around here, hopping around here, not hobbling on your crutches.
Yeah.
So thank you all for watching this week's episode. We look forward to having Will back again next week. Remember to subscribe to the channel, like the video, share it to someone who doesn't even know. Like, how do they not even know? But send it to somebody who doesn't even know that, like, rates are on their way down. Tell them the sky is falling. Just kidding. That's the rates. See you next week.
If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.